All right, everybody. I wanted to do a update video, and this video is primarily for the new viewers and new subs. We've been growing this channel quite a bit now. We're at 1,500 subscribers strong, so definitely appreciate all of you guys joining in if you're new or been a regular to the channel. So I just wanted to go over for any newcomers what my investing philosophy is and the major aspects that I'm looking for, and I'll show you my sample portfolio. I'll go over in more detail how it covers all these four things. Like always, click the like, subscribe button, smash that bell, all that good stuff, and keep on growing this community. So, first, my investing philosophy is to make sure that I'm properly diversified. So that means that I want both U.S., international, large companies, small companies, value type companies, some growth type companies as well. I'm not going to be a good stock picker. I can't just decide that I'm a monkey throwing a dart at a dartboard and they might be better than me. My 6-year-old daughter made some stocks that are doing very well as well. And I just want to be properly diversified to make sure that I get a little bit of the gains of each thing. So if you look at, this is from Wealth of Common Sense, Michael Batnick for Animal Spirits. They do a really good podcast. This shows the past 10 years returns of many different asset classes. So emerging markets, small cap, mid cap, REITs or real estate companies, international stocks, large cap, commodities, treasury inflated protection securities for inflation, bonds, and cash. When you look at this chart, it's hard to find a true pattern on it because we're all over the place, right? So if you're properly diversified, if you have a little bit of each of these asset classes or most of the asset classes, you'll be picking up the gains when needed. And then the ones that are lower, if you do dollar cost averaging, if you reinvest your portfolio into certain percentages, then you'll be buying those low shares, selling the high shares, and then even out to get a lot of good returns. Here is my current percentages and investing. So VYM is large cap value companies, very big companies that have pretty high yield. This is called the high yield investing ETF. So we have Procter & Gamble, Johnson & Johnson, Pepsi, stuff like that. Very big companies. They've been having a pretty strong yield. It's about 3.8% in this whole fund. They've been increasing their dividends about 8% per year as well. V&Q is a real estate investment trust ETF, so it has most of the large cap ETFs. Large cap REIT funds. So they rent out different commercial, industrial, residential properties and whatnot, and then they collect the rents. They could then buy more properties or give a lot of money back to shareholders and dividends. KBWI is very similar to V&Q, but is a small cap real estate investment trust. So the smaller caps in general have lower FFOs for funds for operation. It's a lot easier for them to show more value in the money that they have. It is a riskier fund though because they're smaller companies. Next we have SPHD. This is a monthly cap, pretty much a large blend, which does tie into some small blends. So in the end, it's almost like a mid-cap blend. And this pays monthly, and a pretty high dividend yield. It's about 5% right now, and pretty steady. These are a few of my picks that I made. Main Street Capital. This is a bank that essentially loans money to smaller businesses that have trouble getting loans from bigger banks. O is Realty Income. They do real estate investment trusts, very large company. They use Walgreens, Walmart, CVS, stuff like that. And Newt is another business development company. They've been doing a lot of the PPP loans you might have heard of for companies that want to stay open to hire their workers. They essentially write off the loans, send them to the federal government, and then they get a small fee for it. And that's most of their business model. Then in my wife's Roth IRA, we have more of the internationals. Large internationals, VEA, it's a large cap blend, and small international values for DLS. Again, that pretty much covers most of the international realm in just two funds. And then SLYV is US small cap value. So again, looking at this chart, let's just say the last 10 years, I am a little bit overweighted in the small caps. I do have some in the mid caps as well. Large caps is relatively lower compared to the small caps because I have many years ahead of me for it to grow, but I'm starting to increase this a little bit more, and I have quite a bit in REITs as well. So again, I think that my portfolio is pretty properly diversified. Number two is having a dividend yield that's relatively safe. Going back to these funds, this is, again, large cap blend / value. Very big companies have been having a pretty high dividend yield, and their payout ratios, that's how much money that they are paying out to shareholders in dividends, is relatively stable. And I look for companies that are under 75%. V&Q is a very steady dividend grower. KBWI is a very high yield, and it's a little bit riskier because it's about a 10% yield. But as of now, they've been keeping the dividend intact. SBHD, again, a little bit riskier because about 5% yield. I'm looking for yields that are about 3 to 5%. Once you get a little past the 5% range, it's hard for them to necessarily keep the dividend at that rate. Maine and Newt have higher yields as well. So I want the money that I'm investing to go back into more shares and reinvest. So that's why I'm looking at these higher yield companies. 50% of my portfolio, though, is relatively lower yield. SLIV is about 2.5%. These and DLS is about 3 to 3.5%. And these are pretty steady dividend yields as well. The third thing I'm looking for, and I've been trying to increase this more, is dividend growth. Again, VYM only has about 3.8% dividend, which is actually still pretty good, but it's not 10%. However, VYM's dividend increases the last 5 years is over 8%. So in the long run, if you have a lower yield but a higher growth rate, they could actually catch up and possibly pass the higher yielding companies. And if you're paying a lower dividend yield, usually the payout ratio is lower as well, which makes it more stable. So VYM, MasterCard is the one that I've been adding, and I did do a video recently on it. So MasterCard has a pretty low dividend, but their dividend growth is amazing. So you go to Seeing Alpha and click on dividends. You'll see dividends relatively small. It's less than 1%, but it's been growing really high. It's only 0.5% yield. Payout ratio is really low, though. Look at the 5-year growth rate, 24.57%. That's essentially getting a 25% raise in your dividend every year just by holding the stock. So I've been looking a little bit more into the dividend growth realm. Finally, number 4, I'm looking at covered calls. Covered calls when you own 100 shares of a stock and you're going to sell a position in that. And I'm looking at covered calls with a higher strike price than what the current value is because I want to keep my stock with a very high likelihood. If you look at realty income, realty is right now $61.10. If you go to the options for realty, this is for August, so next month. I just sold a covered call because I already own 100 shares of realty at $67.50. So from 61 to 67.50 is a pretty big jump. If I end up selling the shares at 67.50, I'm pretty happy because I gained about $6 per share times 100 shares is $600 extra. What I noticed about realty income at 67.50, the bid and the ask 0.85 times it by 100, you get an $85 premium for selling that call. I actually sold this call about 5 days ago, and I made it at 95 cents. So $95 back into my pocket that I put back into VYM for the high dividend yields. So again, I'm looking for safe covered calls that are at least 10% over the strike price. It means that the stock would have to go over 10% in about a month and a half in order for those shares to be called, which is fairly unlikely for that to happen. It could happen, but the percents are likely not going to happen. I want to get at least a 1% premium. And realty income is at $61.10, but I made about $95, so that's over a 1% premium of the 100 shares that I have. And I'm looking at 1 to 2 months in expiration. Relatively quicker. I don't want to be waiting 6 months and not sure if the stock will go up that much. All right, so that's my general investing philosophy. I did leave all the different ETFs here. If you're interested in investing in any of those, feel free to do it on your own. you have any questions, let me know, and I'll see you guys next time.